Rajesh Kothari, Managing Director of AlfAccurate Advisors, joins us live on the show as well on Street View at lunch. Afternoon, Rajesh. First up, what's your expectation from Reliance Industries? Because RL watchers would tell you never rule out the possibility of Mukesh Ambani surprising the market. Do you think we could be in for a surprise with better than expected numbers today?
Not too hopeful on that. But with Reliance Industries, the estimates clearly right now, the consensus is right now running for the lower growth compared to the last quarter because of the weakening RM margins as well as because of the gas output. So we would not like to specifically comment before the result. So let's wait and watch.
Okay, what about your views on autos, considering the kind of outperformance that we've seen? And that's a fundamental question, really, I'm asking you. We've seen the growth coming in for Tata Motors. We've seen how the response to Ertiga has been for Maruti, and even Bajaj Auto with the new spaces that they're looking at entering into, be it ASEAN or Brazil, Rajesh, that's going to add a lot of value. So which is the stock that you would still recommend buying even after the highs that some of these stocks have clocked?
I think the lower interest rates will continue to favor the automobile industry in general. So whether it is a CV industry or whether it is even passenger car industry or even the two-wheeler to an extent, I think these companies will continue to be beneficiary of that. That's number one. Number two, not only automobile, but I think you should also, interestingly, there are some really good auto ancillary company as well who will also benefit out of the larger demand from the automobile side. That's number two. And number three, of course, there are stock-specific different movements. For example, Maruti is not only because of the the bigger consumer demand, but also because of the yen movement, versus dollar and cross-currency movements, which either way can swing the stock. So I think these are the three factors which one should closely monitor. And because of the lower interest rate, I think automobile as well as auto ancillary industry, we have preference for these companies.
Rajesh, you want to comment on the banking pack because especially HDFC Bank, in light of strong numbers, would you advise investors to look at that stock even at these levels?
We continue to hold HDFC as well as HDFC Bank in our portfolio. So my views might be biased, but in general, we are positive on BFSI segment. For number one reason is that the interest rates this year are going to be lower compared to last year. Number one. Number two, the fears of asset quality across the BFSI space, I think they should recede going forward, as you would see big steps which are taken by State Electricity Board during last 2-3 months in terms of the power tariff hike. Also, you would see some clearances on mining projects or from the availability of power perspective from the Coal India, so on and so forth. So I think the asset quality fear will also reduce going forward as we move into FY13. And also the valuations are quite attractive as far as PSU banks are concerned. As far as private sector banks are concerned, I think HDFC Bank remains always the core portfolio for us. And I think the results have been pretty decent for HDFC Bank. And we continue to expect similar kind of growth pattern over the next 2 to 3 years for these banks.
Rajesh, what is it that you like out of the IT space after seeing what Infi and HCL Technologies had to deliver?
Interesting question. I think on the overall space in information technology, we are right now kind of I think they will remain like market performer. You would not see any significant what I would say action on the IT stocks. Let's wait for TCS results on Monday. Probably post that one would get clear trend that whether it is a company specific issue or is it going to be the entire industry specific issues. But yes, there are some fear that the BFSI segment from the global perspective there can be lower IT spending, and that can reduce potentially the NASSCOM target growth which they have given between 12 to 14%.
Just a quick final call on what do you think will take the market above the 54-5500 level, because everyone thought that a rate cut would be a good trigger. We saw 50 basis point rate cut which even the market didn't expect, and still we're stuck in that same range.
You are right. I think probably it is going to be the valuations and the better earnings growth visibility. These two factors will make market up higher than 5,500 levels as we progress after fourth quarter results. So probably by June to September, that time you would have better visibility for earnings growth for FY13. If you ask my personal view, then I think FY13 we should see 15% plus corporate earnings growth compared to about 8 to 9% earnings growth for FY12 for Sensex companies, and therefore with a better earnings growth, with a lower interest rate, as well as if you look at the commodity prices, those are also coming down except the crude. So I think there are multiple factors which will drive the market up above 5,500 rate. The only the reason why right now probably it is holding at around current level because of the uncertainty on these tax issues from the FI's perspective. So FI, which have been huge buyers till 31st March, about $8-9 billion has been already invested from January to March. If you see post-March, post-budget, the FI flows have reduced significantly because they are waiting for some clarity on these tax issues. So I think probably over next 1 to 2 months, you would also see more clarity from this tax perspective. And post that, therefore, I believe that 15 to 18% upside on Sensex over next 12 months, I don't think this year is going to be a difficult target compared to how we have seen the last year.